Great. Good afternoon, everybody. It's great to be back in person, as they say. As Noah said, I'm Global Vice Chair of Sustainability at LEK Consulting. I also lead our Global Sustainability Centre of Excellence, and we support organizations through our experience, our proprietary research and analysis. Over the next 15 minutes, I'd like to share with you our observations on how leading companies are tackling sustainability, the challenges they are facing in achieving those goals, and conclude by providing some pointers for how these can be addressed and overcome. The basis for our findings comes from our centre's research, but also a recent global corporate sustainability survey, which we conducted amongst C-suite executives earlier this summer across the US, UK, Germany, France, China, and Australia. But perhaps first some context, which I'm sure many of you are familiar with, but I think it does provide an important backdrop to the momentum that we are seeing. Over the last 2 years, we've seen how organizations have increased the pace at which they are establishing their sustainability agendas. Not only do management teams increasingly realize that what's good for the planet and society can be good for business, but there have been a number of powerful external forces behind these moves. If we start with the consumer, earlier work we undertook this year in the US show that approximately 50% of consumers have switched brands or products due to sustainability, environmental, or ethical concerns. Our analysis also shows that currently sustainability marketed consumer products are delivering more than half of all market growth, even though they make up less than 20% of the overall market. On the investor side, we are witnessing a very dynamic landscape, with about a third of all funds claiming some element of a sustainability stance, and within the strictest definition, there are now over $2.5 trillion of assets with a pure sustainability ESG focus. And the regulators have been busy, and we've heard a lot about that today, as we expect this to continue over the medium term. We have TCFD corporate reporting requirements in the UK, the EU's Corporate Sustainability Reporting Directive, and proposals coming from the SEC. I think it's worth noting that we observe that while in general larger organizations are well prepared for the regulatory developments, we find that smaller listed and many private companies of all sizes are very often not ready for the new requirements. Until quite recently, an often overlooked group of stakeholders are our employees. The fallout from the pandemic and the generational shifts that we're seeing has brought sustainability right to the top of the talent agenda. And it's clear that employees are increasingly prioritizing working for organizations with sustainability values that align with their own. And we observe that strong sustainability goals and policies can serve as a competitive advantage in the war for talent. That's not that funny. I think it's quite important. Given this backdrop, it's no wonder that sustainability has shot to the top of many companies' strategic priorities. The corporate sustainability agenda is broad and deep, with environmental, social, and governance factors challenging senior management and boards to make difficult trade-offs and new strategic choices. There is much focus, rightly, on emissions reduction, and publicly listed companies around the world have been making strong commitments. Some 82 of the FTSE 100 companies have made commitments to be net zero by 2050, and more than 700 of the largest 2,000 publicly traded companies globally have made similar pledges. I can make my slides available after the... I assume you're not taking photos of me, but I will make the slides available because they seem to be in quite high demand. Companies are also demonstrating a strong intent behind its sustainability and ESG strategies. This was also confirmed by recent research. And just a few pointers here that I think are really quite interesting. We found that the majority of executives we spoke to see sustainability as a growth or innovation driver. In fact, 71% did, being made up of 51% who see it as a growth driver, and 20% who see it as either driving an innovation-led approach. We also found it pretty interesting that more than half the executives of publicly listed companies stated that they were willing to trade off short-term financial performance if it benefited long-term ESG factors. I will come back to this later. Organizations also see the number one priority over the medium term as investment in sustainable products and services. So, the commitment of our major businesses is into becoming more sustainable and progressing their ESG agenda is strong. But how are they doing? What we observe is that many companies are finding it challenging to achieve their ESG targets and goals. For instance, despite the commitments and intent, we note that a significant number of the largest global organizations are struggling to progress their emissions ambitions, for instance. A few data points bring this to life. While 82% of the FTSE 100 companies have committed to net zero, so far only 40 are aligned with science-based targets, which, as we know, is the gold standard of validating company emission reduction plans. What that means is that 60% of the largest listed companies in the London Stock Exchange have yet to establish clear net zero roadmaps that investors and third parties that can take comfort from. 25 of the world's most valuable companies, with in excess of $3.2 trillion in revenue, had their climate plans assessed by the New Climate Institute and Carbon Market Watch, who, when they scrutinized those plans, deemed them to be weaker than marketed. I think we therefore observe that progress has been quite challenging for some of our most significant global businesses. And what we wanted to find out was why. So we designed and conducted a global survey earlier this summer, which I mentioned. And from the findings of this research, we uncovered a number of fascinating insights as to the main challenges and barriers organizations are facing as they seek to progress on their sustainability journeys. The single most significant barrier to delivering an organization's long-term sustainability ambition is, in the view of our C-suite respondents, a lack of strategic alignment across key stakeholders, including the board, executive teams, divisional heads, and investors. Probing further, we found that less than half of those interviewed felt they had an executive team and board that are strongly aligned on ESG priorities. In addition, we heard that almost half are struggling to balance the interests of different groups, such as the communities in which they operate and serve and their shareholders. So, no wonder organizations, including some of the largest, are struggling to achieve the desired progress implied by the high-level ESG commitments they're making. In our experience, and I'm sure many of you would agree, that when there is no clear strategic alignment at the top of an organization or division, it makes effective implementation of any strategy very difficult. Misalignment on sustainability and ESG can often manifest itself in an apparent commitment to a vision and set of goals at a high level, but the organization finds it a much more challenging task to develop the required ESG positive initiatives. For instance, a clear and coherent emissions reductions roadmap, gender pay equivalence plans, and an effective diversity program. Our research also shows it's not just alignment that's holding organizations back. As this slide shows, the research identified 3 further factors holding back the delivery of ESG goals. Firstly, while the vast majority of executives feel pressure from investors to increase the level of ESG reporting, only just over a quarter of organizations told us that they had any enterprise-level ESG KPIs. We heard a lot this afternoon about data and KPIs, but we've got to have them in the first place if we're going to measure. And just a mere 3% admitted to having a full suite of KPIs in place for all their ESG priorities. So if you agree with the management adage, courtesy of Peter Drucker, that what gets measured gets managed, then there is little surprise that a significant number of organizations are making limited progress in achieving their ESG goals and targets. Incorporating sustainability and ESG goals into strategy has clearly made decision-making and investment choices that much more difficult. And while we heard that just over half of executives felt that addressing ESG issues should take precedent over short-term performance, we also found that nearly 60% said their leadership team disagreed on how to balance the short-term priorities with long-term goals. So what's going on here? Well, some of this reaction relates, of course, to lack of alignment, but it is also due to the lack of a well-established way of incorporating the impact of sustainability-related investments and actions in financial terms. We believe the more the benefits of these actions can be considered in a financial framework that looks to overall value creation, then these decisions will be easier to make. This is a new and developing area, and one we are increasingly discussing with our clients, and we expect such approaches to become more mainstream over time. The third factor that we identified holding back organizations is accountability, and in particular, not having the right reward framework to drive behavior. 43% of executives we spoke to were concerned that their remuneration frameworks were inadequate, and in particular lacked alignment of leadership pay with progress against ESG goals. That is not to say there are not organizations who have effectively embraced linking executive remuneration to reward progress, but relative to other performance measures used in compensation mechanisms, links to progressing ESG goals has a considerable way to go. And I think we heard earlier this morning Unilever making the comment that they really had to go at this twice, and it wasn't until they aligned compensation to ESG outcomes that they really started to see progress in the organization. These three areas are clearly ones that will have to be grasped by organizations if they want to make more consistent progress in delivering against their sustainability and ESG commitments. So how do organizations need to address these challenges? And further insight can be derived by looking at where organizations see gaps in how they are delivering their strategies. We considered three critical how-to questions in the context of our survey. Under how to win, we observed that nearly half of all executives we spoke to feel that their current product and service portfolio fails to meet the needs of a more sustainable world. So there is clearly work to do by these organizations if they wish to stay competitive and relevant to the industries and sectors they operate in. Executives also told us they believed their organization was not agile enough to address the requirements of establishing a more sustainable business. Less than a quarter felt their organization was fit for purpose on this dimension, and this is compounded by the fact that only a fifth of those we spoke to feel their teams had the required skills and capabilities to deliver their sustainability goals. A perception of the lack of required skills was reinforced by the research, which identified the number one priority for improving ESG governance being to ensure the executive teams have the requisite knowledge to deliver their ESG goals. Having identified a number of the challenges and barriers that organizations are experiencing, we wanted to get a better sense for how these can be overcome. Let's first look at how organizations that are successful are overcoming these challenges, and then I will share with you our thoughts on a clear plan of action companies can follow to maximize the opportunity of success. Through our research and engagement with a range of public and private companies, we have identified 7 key dimensions which successful organizations focus on. I will highlight here just 4 areas, but there is a supporting paper to my presentation today, which is available now, I think, on our virtual booth. Firstly, integrating sustainability into strategy. We find that successful organizations are not managing sustainability as a discrete set of activities, but rather an integrated set of strategic choices, embracing a clear vision and goals, along with key where to play, how to win, how to organize, and how to get it done choices. I was struck today again by comments from Thomas from Unilever and Karen from IKEA, who said very much that it wasn't until they embedded sustainability and looked at it as an integrated set of choices that things really started to happen. Establishing the right culture is critical. Where this is linked to an organization's purpose, while this is linked to an organization's purpose, one aspect of culture that is really important is to establish a sustainable mindset. For instance, in R&D and product development, making it a key priority to future-proof a business's products and services by building sustainability into the design and prototype stage. A further area is sustainability benefit assessment. Here we observe successful companies leading the way in taking a more holistic approach to investment and capital allocation by factoring in the sustainability impact and thereby enabling more informed decisions. Sustainability and ESG goals have made supply chain management much more strategic. And this in turn requires an increased level of sophistication given the impact the supply chain has on an organization's ability to achieve its own ESG goals, be it Scope 3 emissions, labor practices, and raw materials sourcing. We find that successful companies understand in detail the impact of their sustainability goals on their supply chain partners, and hence how to engage proactively in order to further their own company's own objectives. I would like to conclude my presentation by setting out a 5-point plan for action that organizations can adopt to have a better chance of developing its sustainability and ESG strategy. The plan seeks to address the key challenges we have identified from our discussions with senior executives, as well as the experience of the most successful companies. Firstly, we see it as critical for senior management and boards to drive strategic alignment across the organization. And I've highlighted 2 really important aspects here. Be sure to establish a common language for sustainability initiatives, use consistent vocabulary, and avoid ambiguity. This is important at the board level as it is with executive teams and divisional management, and then cascade that through the organization. The second aspect involves developing a clear vision and goals for the organization, embracing sustainability, and then identify the key strategic choices required to achieve those goals, particularly the where to play and how to win choices. Having identified the key strategic choices, prioritize those that support and accelerate the organization's sustainability goals in areas such as a company's product portfolio, brand positioning, innovation, and operations. This is where organizations need to analyze the financial and non-financial benefits of each choice that helps achieve the stated ESG goals. Involve the full leadership team in this activity and build and reinforce alignment. The third element of the plan is to create an agile organization that can respond to the new and challenging demands that sustainability brings. In doing so, make sure the required skills and capabilities are identified and, to the extent needed, addressed and upgraded through training and recruitment. Where possible, organizations should seek to increase the flexibility of their operating model through, for example, cross-functional sustainability teams, specialist service providers, and partnerships. The final 2 elements of the plan we believe are critical and address measurement and accountability, which you've heard me emphasize earlier in my talk, and they work most effectively when combined. It's critical to establish clear KPIs. Organizations need to define what is required to achieve their goals and targets, be it energy usage, supplier emissions, gender pay, diversity, women in leadership, employee training, whatever you feel you need, there's a set of KPIs to develop. And set up those KPIs so that they can be tracked, measured, and reported frequently. Finally, we would strongly recommend aligning compensation to the new KPIs to incentivize and reward performance and progress towards sustainability and ESG goals. Thank you. Well, I hope you have found the talk this afternoon helpful and agree with me that there's quite fascinating insights from the research. So as a senior executive, head of sustainability, or a portfolio manager, if you're finding this hard, you are not alone. And I hope that some of the perspectives I've shared with you today, you can take forward and help in progressing your own sustainability journeys. If you'd like access to the report, which is quite substantive, please, there's a link in the virtual booth, or if you want to, you can scan me up there, and I think you get it. But once again, thank you very much for your time this afternoon, and I'm over time.